Welcome to the Daily Update, where I'll go over the action in the market for Monday, January 29th, and then we'll see how things look for Tuesday, January 30th. We surprisingly had a pretty solid up day. Now, it looked like it was going to be really boring, and it started out that way, but then some results from a treasury auction came in, and it was taken as good news, and we saw some buying later in the day. So we're still looking positive, but at the same time, we're becoming more and more overbought. But as I keep saying, this can go on for a while. We typically will see some kind of a washout when we're going down and things are getting oversold, and we can sometimes bounce up out of that. When we're dealing with all-time highs, that can drift for a while and take some time to actually play out. So we see more spike bottoms and more rounded tops. Now, I'm not saying we're at a top, but the market has been overextended to the upside for, well, last 2-3 weeks. And at some point, you would think folks are going to want to come in and take some profits and actually push some prices back down. But it doesn't seem to have happened yet. Now, that could change at any time. We have some big things happening in the upcoming week. The Fed will make their announcement on Wednesday. We're going to get the big employment report on Friday. Those two things taken together means that this is a pretty important week. So let's go back and talk about what happened. At the open, we had a flat open, and it was a real yawner. And prices did go positive, and then we came down to the unchanged level, a very common thing to have happen. That ended up providing some support. Then we remained positive and drifted higher, but there was not an awful lot of conviction. We got up to R1 at 49.05. So now we're above the 4,900 level. And then buying took prices up above R2 at 49.18, and we closed at the high. So it was later in the day that we saw some real buying coming in. We were up 0.76%, but we were below average when we look at volume. We are positive with our technicals. It's going to be about what is the Fed, not what they're going to do, but what they're going to say in Wednesday's session. The market's really going to be anticipating that. Things might be a little bit quiet in Tuesday's session ahead of that. Just think about this. Do you want to take some kind of big position before that happens? Or do you want to wait until things are a little more clear? Not that they're ever crystal clear, but just that the market seems to have some kind of a conviction behind it. And we're keeping an eye on the geopolitical events. There were some things that happened over the weekend, but the market just isn't really responding to those things right now. So some comments that we can make. We did set a new all-time high for the Dow, the S&P, and the NASDAQ 100, with the S&P now being above 4,900. This is the geopolitical event. There was a drone attack by Iranian-backed militant group and Iranian-backed militant group on a U.S. outpost in Jordan. That's more of this potential escalation of what's going on in Israel, since Jordan is right next to Israel. And it killed 3 U.S. soldiers and injured many others. What's going to happen now? Is there going to be some kind of a response from that, from the U.S. side? Is there going to be an escalation from the Iranian backside? That's kind of the balance that things are in right now. But you would think oil would have really gone up. That's a major oil producing part of the world. But oil actually ended up declining down to $76.87 a barrel. $76.87 a barrel. So stocks didn't react positively in the afternoon. They came out with their, how much are we going to borrow? And they actually lowered the amount that the Treasury is going to have to borrow to help cover the debt and the shortfalls in the budget. And that ended up being lower than expected. The market liked that, and so it ended up going higher. The mega caps ended up outperforming, and that's still where we're seeing a lot of the strength. And I have another chart to show you later that kind of backs that up. But on a short-term basis, we still have our usual list here of short-term indicators that are looking extreme positive, but they can stay this way for a long time. This includes the Stochc RSI, the Williams Percent R, the CCI 14, N20, the stochastics. Those are the ones that are usually there. And they can even get there when we're not necessarily screaming to the upside. We're just having an upward movement because these are pretty touchy indicators. Our standard deviations chart, we're still up in that +3 category. The boom indicator, we had been extreme when we look at the intermediate term boom indicator. Now we're starting to look extreme even in the short term. And then the RSI based on 9 periods. In the intermediate term, the CMB composite, which has been on the list now for a few days. The oscillators are starting to look a little extreme, but they are positive. The Sean trend meter, the RSI based on 14 periods, the bullish percent index for the S&P and NASDAQ 100. As I stated before, the boom indicator, intermediate term, and then the new high, new low study based on 10 periods for the S&P. Long term, we're still looking extreme with our 150 and 200-day simple moving averages. And this is the scenario. We'll see if it's going to change or at least modify a little bit in the upcoming week to see what are they going to say right after the announcement is made, and then what is Chairperson Powell going to say in the press conference? Is that going to adjust this current scenario that the Fed could in fact be done raising rates and possibly even getting to the point where they might cut rates? The market is still kind of hanging out for that March area, but it's looking less and less likely. If you watched the weekly video, the probability of that is really dropping right now. But at the same time, if we get some really strong economic reports, the Fed has stated that they're willing to come in and actually raise rates. The dollar was up and interest rates were down. We came down to that 4.09% level with the 10-year yield, but it's still above the 4.02% level that RenMac determines. That's when it can start to bite into corporate profits. The 10 to the 2 and the 10 to the 3 month, those yield curves are still inverted. We didn't change as far as sentiment is concerned. You might have had some hedging going on ahead of bigger things that are going to happen later in the week, but we're still extreme positive at 77. We've ticked up above that 75 level. And that's when we start to entertain the idea of using this as a contrarian indicator. But for right now, our trend is positive. The green line's on top. The ADX shows that it's a strengthening trend. We're above the moving averages, both in the short and intermediate term charts. Our momentum is positive because we had the up day, and our bias is positive with the up day, and our momentum the last 2, 3, 4 days, that continues to be positive as well. We didn't get any economic reports in Monday's session. Then I have one chart. This is the chart I was talking about, where if you look at the earnings per share revisions that have been coming out, for most of the S&P 500 and the non-Magnificent 7, those revisions are going down. But if you look at the Magnificent 7, those continue to go up. And that's why we're seeing the mega caps really outperforming. That's just another reason why. Here's our intraday chart where we had a flat open, but it was positive. We came down to the unchanged level, kind of sat down here for a little bit. That ended up providing support. We drifted back higher. Then this is when the news came out about them needing less money in the Treasury Department. And that's when the market really started to go up. We got above R2. R3 was way up here somewhere. It's not even on the chart. But we ended up closing just about at the high. Here's the intraday chart where when we started trading Sunday afternoon or evening, we were down just a little bit, but then things started to turn more positive as Europe opened. Here is the cash session, and here's the strength that we saw going into the close. And we're seeing things little changed in the initial overnight session. We're not really seeing anything strong as far as growth versus value here. They're kind of equal with each other. They were both up on an intraday basis, but the blue line and the red line are pretty much on top of each other. We did see a little bit of an improvement when we look at S&P 500 growth to value, where growth did outperform on the intraday basis. Then our end-of-day charts where growth did close a lot higher when you look at the large caps, and it also outperformed with the mid caps as well as the small caps. So that's still showing some improvement. Here is the end of day growth to value ratio for the S&P, where it actually ticked down just a little bit here. We had been showing some improvement. We want to see this turn and go back up, but it didn't do that based on this measurement. And we're also keeping an eye on discretionary, where it was up in Monday's session. Staples were also up. We saw a little bit of a bounce with the ratio below, but we want to see this continue to go up to match what we're seeing in the S&P 500, and that is not happening. And a lot of this has to do with Tesla underperforming. Keeping an eye on our trend, the ADX is above the moving average and advancing. That's a strengthening trend. The green line is on top, so that is positive. We're seeing the same thing in the short term with the ADX above the moving average and the green line on top. We ticked down just a little bit with volume, but over the last number of trading days, we've been above average when you take them together. Here is sentiment with the Ulcer Index, one of the fear gauges that we follow, showing that there's just not a lot of fear right now. We ticked up a little bit with the VIX on the line chart as well as the bar chart, but we closed well off the high. And like I said, this could be some hedging ahead of some pretty important announcements and the employment report on Friday. The VIX of the VIX is also showing just a bit of a tick up in volatility. We came up with the bar chart as well as the line chart after giving us a very, very low reading on this chart. The equity put call ratio actually declined on an end of day basis. We saw this big spike up ahead of last week's economic reports and then the weekend. And now that could have been just some unwinding taking place once the weekend passed. And we're continuing to go back up slightly with our 5-period simple moving average. Personally, I'm taking this more as an anomaly, that this is actual hedging going on, not necessarily a change in the overall climate of the market. Now, if this keeps going up, I'll have to modify that attitude, but we fell pretty far pretty fast. We're seeing some additional hedging coming back in right now, and so it's not surprising to see this going up. We are keeping an eye on the SKU index, which looks at out of the money options to give us another read on fear. And the market is still anticipating something happening. We're getting up into this red area. We don't know if it's going to be up or down for right now, but according to this chart, they do expect some kind of a big move. Looking at our advanced decline line studies, we're finally breaking out now based on price, and we are showing some improvement here based on volume. We're coming back up to these previous highs, and we're trailing off because we're pegged at the top with the new highs, new lows study. We're kind of just going sideways there, where we're starting to flatten out with our 10-period moving average. But you can just look at all the green compared to all the red, and things are positive, even though the green lines have been coming down. We are positive when we look at our advanced decline ratio, both in the short and intermediate term. This is also looking positive with the smart money. The accumulation distribution is above an advancing moving average. We're seeing some improvement here with the Chaikin money flow, another smart money indicator, and we're turning back up slightly with the Chaikin oscillator, so we are positive there. And this is one that I include, then don't include. The black bar chart is the S&P 500, and the red line is the the NYSE advanced decline line. So we're comparing a smaller, on a relative basis, index with the broader market, and we are seeing some improvement with the broader market advanced decline line. And looking at our advanced decline line studies, where we are seeing a bit of an improvement with the NYSE common stock, we're starting to break out with the S&P. We're coming back up with the mid caps and showing some improvement, but still have a ways to go with the small caps. In the short term, we're looking pretty healthy for right now with the S&P daily chart. We're just continuing to go up higher. We do have a pivot point here, which may act as overhead resistance. On the bottom, we did drop to below average, and that's usually a concern. When we're breaking out, setting new all-time highs on a decrease in volume, that usually is something just to be aware of. When we look at our short-term indicators, the Stochk RSI is extreme positive, as is the Williams percent R, the CCI 14, and the CCI 20. So we're still extreme, but we can stay extreme for a while. We are showing an improvement with the 20-period exponential moving average. We're also coming back up with the 50, as well as flat to slightly going up with the 200-period exponential moving average. The force index is above the midpoint and is positive, so that's still looking good. We're still extreme positive in the short, intermediate, and long term with the stochastics charts. We're at the high end now of the +3 channel with our standard deviations chart. And this is just showing that maybe we've gone up a little too far too fast. Intermediate term, we're still looking okay with the balance of power, even though it ticked down slightly. We're still positive with the trend that we look at on the go, no-go system with dark blue bars. We're also positive as we continue to hug this highest high value and climb higher. The TTM squeeze is showing some improvement with the lighter blue bars, and that's going back up. The CMB composite is still extreme positive. We actually turned down a little bit with the ease of movement as we were gyrating around, and this goes back 14 periods to calculate itself. That might be why we're actually seeing a little bit of a turn down here. We did come back up just a little bit with the Arun, with the green line all the way on top. We're seeing sellers continue to decrease. We're above zero, so this chart is positive. And this is a divergence that I was trying to play up on in the daily video for Monday and over the weekend, where we were seeing the S&P set all-time highs up here based on price, but we were still negative with the McClellan oscillator. We have turned back to positive, but we're still seeing a bit of a negative divergence here. Now, these are moving average based indicators, so they can't help but negatively diverge from time to time. But this is improving, but we still want to keep an eye on this. And because we went back above zero, we're starting to turn up based on price. We've already been turning up based on volume. Sometimes the volume indicator is a leading indicator. When we look at the NYSE McClellan oscillator, we're also above zero and advancing. So in the broader market, we are showing some improvement. We're starting to turn back up based on price, turning back up based on volume. This was a negative divergence as well that I pointed out over the weekend. If this can continue to show some improvement, that negative divergence may go away. With the Swenlin trading oscillator, we actually declined based on price, but we continue to advance based on volume. However, both of these are positive since they're above zero. And we're looking extreme with the PMO. Even though we're positive, we're turning back up based on price and volume. We're just about ready to cross with the volume. We're still more negative based on price. We're showing some improvement with the PMOs that are rising. We're also showing some improvement with the buy signals. We continue now, since kind of the early part of December, to be extreme positive with the PMOs that are above zero. We are positive with the Elders Impulse system for the S&P. We're positive with the parabolic SAR. We're positive and potentially getting extreme with the slope oscillator. The MACD is turning back to looking positive. So in the short term, we're positive, but looking extreme, showing improvement in the intermediate term. And we're starting to cross back above the moving averages in the long term when we look at the tricks in KST. We're above all of the plotted moving averages in our moving average tree, and we're starting to see the red line here, which is the exponential moving average that moves faster. It's now crossing above the blue line. That just means that there's more movement behind the upward trend. We're dancing right around this 70 level with the bullish percent index. We go a little bit above, a little bit below, and it's still trying to figure out what it wants to do. We turned up just a little bit, but we're still positive with the NYSE bullish percent index. We were flat with the NASDAQ 100 bullish percent index, but we are still extreme positive. The money flow is just underneath, giving us an extreme reading. The ultimate oscillator is still positive. We're positive with the vortex, even though we're flattening out a bit with the green line. And the RSI, based on 14 and 9 periods, we are extreme positive with both. On balance volume continues to be positive, and we're showing some improvement with our 200 period moving average study for the S&P. This is turning back up. We saw a little bit of a tick up here with the 50 period moving average study. The Copic curve is still positive. The Sean trend meter is extreme, but not really extreme right now. And we were extreme in the intermediate term when I made Monday's video. Now we're getting extreme in the short term. So we're getting kind of far away from the 20 period moving average. We've already been far away from the 50. We continue to look more positive when we look at the 200 period moving average study. I took out the Fibonacci slide for right now because there's really nothing to show. So when we look at a trend using different kinds of charts, the Heiken Ashi is still positive. The Kegi is positive. The Renko is positive. The 3-line break is positive. Long term, we're still extreme with the 150 and 200 period moving average studies. We did show some improvement with the equal weight. That's the red line, and it's starting to come back up and show some improvement compared to the weighted S&P 500. So we came up just a little bit with the equal weight to S&P 500 ratio because the mega caps did outperform in Monday's session. This is longer term. This is still a negative divergence where we're setting all-time highs with the Dow. We're not even coming back to recent highs with the transports. And we are just seeing here where the transports continue to underperform the Dow. The Dow is coming right up to this pivot point. It set another new all-time high, but is this overhead resistance going to cause some problems? The diamonds continue to be positive for the Elders impulse system when we look at the trend. And the NASDAQ, it's been chopping sideways. It's last number of days, it's been in a sideways type of movement here, but it's still holding up above this pivot level support. And I want to show this is kind of the last holdout for the Fibonacci charts, at least the ones that I show, where we are showing some improvement here, but we're continuing to be in no man's land. The NASDAQ 100 has also been chopping more or less sideways. It hasn't really broken out above these previous highs, but it's still hanging in there for right now. We have switched back to positive with the QQQs when looking at the Elders impulse system. The momentum for the NASDAQ 100 is still positive. The small caps are trying to break out, but they haven't been able to get back above this previous high. And if they do that, then we have this other high set back in late 2023, wondering, okay, is the January effect toast for right now? But we remain positive with the small caps when we look at the Elders impulse system. This is encouraging, though. We're looking more positive with the Russell 2000 small cap index. The RSI is above 50 and advancing. We were able to close above this resistance level. This has been a real area of problems. Now, can it hold on to that? Is this going to keep going up or just fake everybody out and tease everyone and just end up dropping back down below it? We are showing some improvement with the momentum, and it's just getting ready to cross over positive. The mid caps pretty much chopping more or less sideways, kind of closing up at the upper end of their recent range and still below the highs that were set in 2023, but they're still positive when we look at the Elders impulse system for the mid caps. The FANG index, since these are the mega caps, this continues to set new all-time highs. The financial sector is still hanging in there for right now and is in an uptrend. The dollar did show a bit of a bounce here, even though it's still in a longer-term downtrend. We did decline with the 10-year yield, where we advanced with the 10-year based on price. And then looking at our growth to value studies here, we're coming back down a little bit with the Qs to S&P, but we're still above the moving average. We ticked up a little bit when we look at discretionary versus the S&P, but this has really been underperforming. Large cap growth is still hanging in there when compared to large cap value. So when we look at our different cap related indexes here, we're looking a little better with the large caps, the mid caps, and even the small caps. And we're still looking extreme positive, even though we're dropping down a little bit with our 10-day average of the S&P 500 highs minus the lows. We're still positive when we look at the 5-period moving average of the highs minus the lows for the Amex, NASDAQ, and NYSE. We are coming down a bit here with the 2-year yield, which often gives good support to the S&P, and that's what happened in Monday's session. So what's our outlook for Tuesday? We're dealing with earnings season. It's pretty much in full blast right now. About 20% of the S&P 500 companies will end up reporting this week. We're wondering, is the January effect, is it ever going to come back? I mean, we're seeing some improvement, but we should be looking at new highs and surpassing highs that we set in 2023. We are 0 for 2 with the trifecta. We won't know the final score until the end of the month. But what's interesting is I ran across some research here that says when 2 of the 3 indicators are negative and the third one is positive, so if we have an up month for the month of January, we on average gain 20% for the year. So that doesn't mean that all hope is lost if we end up with a 1 to 2 score. Now, if all 3 are negative, if we really start diving and we end up closing the month of January down, we tend to average a 3.6% loss when those things. So the January effect, or not the January effect, but the month of January, that's kind of the real big thing to watch for now. Then the technicals are positive. They are continuing to show some improvement, but we continue to be overbought. We will get the FHA Housing Price Index, the Case-Shiller Home Price Index, consumer confidence, and the JOLTS job openings. And then we're just watching all these geopolitical events to see if something actually does happen there. Here's the economic calendar in Wednesday's session. That's when the Fed's going to make their announcement at 2 p.m. Eastern. We're going to get ISM manufacturing on Thursday and then the big employment report on Friday. Seasonally, for January 30th, we're neutral to negative with the Dow, neutral to positive with the S&P, and neutral to negative with the NASDAQ. And then following this orange line here, this is when we take the average of the fourth year of the presidential term, where we are kind of still in that period where we see some seasonal strength, but be aware as we get into the latter part of February and into March, that's when we might see some weakness. And we will be on the 20th trading day of the month, second of the last trading day, where we're a little bit positive here with the green dashed line showing some positive seasonality. Also watching this, we're at the end of February going into March. Sometimes we see some weakness before we see more strength going into the end of the year. We're seeing kind of that same thing with the Stock Traders Almanac statistics, pretty choppy, a little bit of downward move before we see some strength. And then this is comparing, this is updated with the purple line in here. This is how we've been performing in 2024, where we got off to a really rough start, but now we're starting to come back and match up with when the sitting president is running for re-election. We think that's what's going to happen. We don't really know for sure. We will be in Tuesday's session, which tends to mean that it's the weakest day of the week. And that's based on what happened in 2023. And then just to kind of look ahead a little bit, this is a plain vanilla chart showing February, where we tend to start off pretty well, and then we chop more or less sideways. We see some strength going into about Valentine's Day, and then we tend to see some weakness later in the month of February. So just be aware of that seasonally. And then this will be the chart that I update and show you what day we're on. This is for the month of February, kind of showing that same thing, but it's a bit more annotated. And then when we look at February, the performance statistics from 1950 up to 2023, where we're up 40% of the time for the S&P, we're down 34% of the time. So it tends to be, it's up 54.8% of the time. It's a little more positive than negative. And then this is, I got this from Dan Bird, where he was able to make this average election year going back to 1950, where during an election year, we chop around like we have been, and then we see some weakness going into about the middle of March. Then we see some seasonal strength, and then we see some more weakness coming in the fall when they're like, oh my gosh, who's going to win the election? And then after the election happens, that's when we see some strength going into the end of the year. It may not play out this way. This is just seasonally what has happened since 1950. So our scenarios, not going with the downwind right now, even though we are overbought. We're not really confident in the upwind, but we have to go with that because that's what our charts are telling us. But we are overbought. And it's like, when is this market going to finally be exhausted? It just seems to have no end. But at the same time, we have to go with that. That's what our charts are suggesting, and that we are positive. We're not going with the sideways trend or the neutral type of an approach right now because both of our ADX charts are suggesting that the trend is strengthening. The warning signs, I haven't showed the risk on, risk off chart for a while. It's just been chopping all over the place. And this longer term negative divergence between the Dow and the transports, that is a concern. We're seeing some improvement, but we still want to keep an eye on the McClellan oscillators and the summation indexes because they were showing some divergence there negatively. We want to see, can that continue to improve? Positive signs, growth has still been showing some improvement overall. The equity put call ratio, it's been ticking back up, but in the bigger picture, it's going back down. If it keeps going back up, then I'll probably switch this over to the warning slide. Our oscillators are improving and they are turning more positive, but they are also extreme positive, especially in the short and intermediate term. The parabolic SAR and the vortex charts are positive. The NASDAQ 100 and S&P 500 bullish percent indexes are positive, but also extreme. The Copic curve is positive. The momentum for the NASDAQ 100 is positive. Small and mid-cap growth is positive, but it's still chopping sideways in a range. The financial sector continues to be positive. Our conclusion, I haven't changed this in a few days now. We're positive. Every day we go up, we're showing some improvements, but we are overbought. We say that in the short term, we're looking still overbought. In the intermediate term, we're also overbought in the long term, but we're positive in all the different time frames since we're above all of the moving averages that we plot. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.